Welcome to the February Market Thoughts video. My name is Maria Considine King, and I'm joined by Brad McMillan, Chief Investment Officer at Commonwealth Financial Network. Welcome, Brad.
Good morning, Maria.
Brad, the equity markets, both domestic and international, performed well in January, the best for the month since 1997. To what do you credit their performance?
It was a great month, Maria, and I think the biggest factor is the resumption of the risk-on trade. People are getting more comfortable with assuming the risks of being in the markets, and because of that, they're more willing to put into markets that, in many respects, are very attractively valued. This is expressed in a couple of different ways. I think one way to look at it is what traders call technical factors, and one of the most common are moving averages, and the S&P is now at a point where it's trading consistently above the 200-day moving average, which historically has been a very positive sign. In addition, we've also recently had what's called a golden cross, where the 50-day moving average crosses above the 200-day moving average. And this has historically also been a sign of continued strong performance.
So those are the technical factors. Can you speak a little bit to the fundamentals?
The fundamental side is a little more mixed. Earnings have been absolutely terrific over the past year or so. They seem to be starting to top out a little bit. While companies are still beating estimates, they're not beating by quite as much or in as great a percentage. So you're starting to see earnings top out. The question for fundamentals is, will multiples expand to offset the earnings? And there seem to be some signs that indeed that will happen, which is typically consistent with a risk-on trade going on. So overall, I think it's a little more mixed, but yes, I think the fundamentals do support continued price appreciation.
At the same time, housing and the situation in Europe continue to be problematic. Do you think that the U.S. economy has turned a corner in spite of these conditions?
I think we're getting very, very close for a couple of reasons. First of all, housing is as affordable as it has ever been. And I think that's worth repeating, because even with everything else that is going on, you now have a situation where in many markets it's cheaper to buy than rent. And that will, over time, have to lead to a housing market recovery. Now, housing is a terrific economic multiplier sector. In other words, when housing starts to recover, it drives recoveries in many sectors. And once housing does start to recover, that's going to really help support a self-sustaining recovery. Are we there yet? Probably not quite. We're still seeing price declines, but nonetheless, we're getting very much closer than we have been a couple of years ago. Situation in Europe is a little more problematic. My personal belief is that they will work it out. However, we're not there yet, and there's bound to be some bumps in the road along the way. And if they didn't work it out, that would be problematic.
What worries you then?
Well, I think the European situation, depending on how problematic it gets, certainly is something that we need to keep an eye on. You've got Greece going into its own endgame. You've got Portugal as a problem that's being appreciated more and more. You've got the other countries. Really, that's something that becomes a political issue rather than an economic issue. The other political issue, which can become an economic issue, is the Middle East situation. If the price of oil skyrocketed again, that would be a significant detrimental factor. An increase in the price of oil acts as a very significant tax equivalent on the U.S. economy, so that would tank consumer spending right there. Consumer spending is one of the largest sectors of the economy, and for that to happen would have a significant negative impact on the recovery.
What keeps you optimistic?
Overall, I think the U.S. is the best positioned of almost any country for a variety of reasons. First of all, we have relatively less exposure in the form of exports to the rest of the world compared to most other countries. Second of all, the cost of our inputs would actually be positively affected by recessions in the rest of the world. In other words, if Europe and China were to slow down, oil would become significantly cheaper, which in the flip side of what we just talked about would act as a significant boost for the U.S. economy. So we're very well positioned. We have a self-sustaining recovery that appears to be starting to get going. Employment is coming back. Again, we're not out of the woods yet, but cautious optimism is now, I think, the most appropriate stance to take.
Great. Well, thank you, Brad.
Thank you, Maria.
And thank you. Please join us next month for the Market Thoughts video.